This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, you asked a very good question in this week's report. Is this a bear market? I'm hearing that from everybody. So what's your take on that?
Yeah, well, I used that title for a reason. I got that question a lot too. I think in a way it's the wrong question. In some sense, there's a bull market and a bear market going on all the time. It just depends on the asset class. And I think people get caught up in what's going on with stocks and what's going on specifically with the S&P 500. When, a lot of people don't own the S&P 500. Our clients don't own the S&P 500. Well, the vast majority of our clients don't own it. We made a decision last year not to buy the S&P, which it is part of our normal strategic allocation. But we decided to shift to a dividend version, dividend ETF. The select dividend in one. Well, we used several dividend ETFs, put it that way, just because the S&P was so overvalued. So we made that choice last year. But even if you own the S&P, you're down about 12%, almost 13% from the high. Typical drawdown or typical, top to bottom range for the S&P on a yearly basis is around 13.5%. So what's happened so far is pretty normal. Now, if you own the NASDAQ, you're down over 20, so you're in a bear market. If you owned the small cap index, which we do own Russell 2000, that did hit bear market territory as well. Now, we tried to minimize it, but we'll talk about strategy and tactics. I think I saw that on your notes. We'll talk about those things later about the difference. But so there are parts of the market that are already in bear markets, and so when you're asking that question, I'm not sure exactly what you mean by it. So I think you have to be specific and think about what you own. I think it's more important to focus on your situation rather than some abstract thing like a bear market in the S&P 500.
Well, let's take the emotion out of everything that's happening. I mean, with emotion, it's really easy to get distracted. So let's pull the emotion out. I'm going to ask you about four things, and you give me your take on, well, we'll just call it on the facts, where we are right now. First one is the U.S. economy.
Well, look, the U.S. economy last year was fairly strong. It did slow down in the third quarter last year during the so-called Delta wave. Did reaccelerate in the fourth quarter. Now, the question is, what's going to happen now? Well, when we look at the things that we watch, and remember, there's a difference between looking at the day-to-day stuff like Jeff does and me trying to take a snapshot of the big picture. We move a lot slower than the day-to-day stuff. So I look at things like the Chicago Fed National Activity Index. Well, the Chicago Fed National Activity Index actually went up in January from where it was in December. And December had been initially reported as a negative number, slightly negative, slightly less than zero, and got revised to a positive number. So the 3-month moving average, again, try to smooth out the month-to-month, the day-to-day. The 3-month moving average is at 0.42. That means that the economy, according to the CFNAI, is growing slightly above trend. That has not changed yet. So I think the economy, it's okay. I'm not going to, say that we're in a boom or anything. We're not. But the economy is growing. It is not in recession. And I think we need to just look at where we are rather than trying to guess where we're going to go.
All right. One of the things we watch is credit spreads. What are the facts there?
Spreads have widened. We got down to a low of about 3%, which is extraordinarily low, by the way. That is a very, very tight spread. We're talking about the difference between a junk bond yield and a treasury yield. Got down to 3%. We're now at 4%. 4% is a pretty average number. You don't run into problems. I mean, 2020, you got up to 9%. We had two episodes, 2011, 2016, where the number went up close to 8 or 9. We didn't get a recession. So, you go back and look at 2008. What's happened going up from 3 to 4, a 1% change in the spread, it means nothing. It's noise.
What about the yield curve?
Yield curve has flattened. What does that mean? A yield curve that flattens means that future economic growth somewhere down the road is going to be somewhat lower than it would be with a steeper curve. That's all it means. It doesn't mean if you're at 25 basis points, which is where we were as of Friday, the difference between the 10-year and the 2-year rate, it doesn't mean anything except that. And in fact, I think people miss this, but a year ago, the yield curve was a lot steeper, which means At that time, it meant that economic growth was going to be better in the future. And guess what? Here's where we are. Economic growth is better. So I think people focus too much on the flattening part of it. Look, even when you invert the curve, and by the way, a yield curve inversion, we associate that with recession here in the United States, but looked at on a global basis, yield curve inversions are not that great of an indicator of recession. But you know what? Everybody wants to look at it. And by the way, too, I think it's one of those things too, where, the more people that know about something, the less likely it is to work. Everybody knows about the yield curve. When I started in this business, I didn't know what a yield curve was. 30 years ago, nobody paid any attention to this stuff. Now everybody pays attention to it. So, and that affects their behavior. So I don't know if it means as much as it used to. But the bottom line is this. As of a few minutes ago, we were about 27, 28 basis points because bonds are getting hit. Rates are up today. That means nothing. It doesn't mean that we have a recession coming. Even after you invert, the average time from inversion to recession is 16 months. So let's not get too hyped about this. It is a flattening curve. It's not necessarily a good sign, but it does not mean recession.
And now then talk about interest rates, especially in light of the Fed and possibility of raising rates this week.
Yeah, I think people are overly worried about the Fed. Jeff and I violently agree that the Fed really doesn't matter all that much. Look, if the difference between contraction and expansion is 0.25% in interest rates, I think we got a big problem. I don't think that's as big a problem as people think it is. Look, interest rates are rising. We've had a rise in inflation expectations during what's going on with Ukraine. That probably is going to fade some. I think it may have peaked already. In a sense, what happened there was people started buying tips. They got worried about inflation because oil went to $130 a barrel. Well, oil's down to 102 and change today. So maybe that starts to fade some. But the bottom line is interest rates are on the rise. And I don't think that's a bad thing necessarily. They had come from very low levels. In fact, this morning we hit 209 on the 10-year. That's the highest rate since all this started, since COVID started. So look, it's not a negative thing. We would like to see real rates rise more. They had been rising. The Ukraine situation comes along and they got hit. As I said, people bought tips. They got afraid of inflation. Hopefully that starts to fade because real rates are really kind of the intersection of savings and investment and really economic growth. And negative real rates is not a positive sign for the economy long term. We need to get those rates into positive territory. So hopefully we start to see those rise more in line with what nominal rates are doing, and we can kind of put this behind us.
So based on all these things we've talked about, any possibility of changes to Alhambra Portfolios?
Well, there may be tactical changes, but there's not going to be any strategic change. Strategic change, which would be a change in the underlying strategic allocation, that comes when we think we're on the verge of recession. If we think that recession is coming fairly soon, we may take our strategic allocation, just say as an example that you're in a moderate risk portfolio with 30% in bonds. If we believe that recession is on the way, we may take that to 40% bonds. But we don't, but that's that. Let me just say, strategic portfolio does not get changed that frequently. In fact, it's rare, and it should be rare. A strategy is a plan. And if you have your plan, if your plan changes all the time, then I don't know if you have a plan. Anyway, the point is that no, we don't have any strategic changes in mind. We may make some tactical changes. We have a lot of cash right now, and if this turns out to be just a correction in the S&P or whatever we want to call it, if we can find things that are going up that are trending higher, then we might want to put some of that cash to work. I don't think that sentiment is quite negative enough to really call this a bottom yet, but there is a lot of negative sentiment out there. So maybe it's time to put some money to work. But those are tactical changes, not strategic ones.
So for the individual investor, I want to read this quote that was in your report this week. You said, forget whether this is a bear market or a correction. Your success or failure in investing should not be dependent on making perfect tactical choices. It should be and will be determined by the design of your portfolio, your strategic choices. So talk just briefly about strategy versus tactics. You've hit it a little bit already.
Yeah, I think people really get these confused sometimes. Look, a strategy is nothing more than your long-term plan to achieve whatever goal you're trying to achieve from a financial standpoint. So in investing, that takes the form of an asset allocation plan, a target allocation. How much do you have in stocks? How much do you have, how much do you have in bonds? How much do you have in real estate? How much do you have in commodities? All that that decision that you make, that underlying strategic plan to achieve your goal. It might be you're a moderate risk investor and you want 30% in bonds, and then you have these other asset classes that you're going to invest in as well, like we do. We have large cap, small cap stocks. We have real estate, commodities, gold, and bonds. That's what's in our portfolios all the time. That's a strategic choice. We made that choice because it's a less volatile overall outcome than you get with just stocks and bonds. That's your overall plan. Tactics is how you implement the plan. What kind of large cap stocks? Are they going to be foreign stocks? Are they going to be dividend oriented stocks? Are they going to be growth stocks, value stocks? Those are tactical decisions. I think what most people have is no strategy and all tactics. And that's a recipe for disaster, because you end up trying to make tactical choices in the middle of a crisis. And it's hard to do because your emotions get in the way, and it's very difficult to make those choices in a wise way. So I think most people need to take this time and say, look, what is my plan? Do I have one? And if you don't, you need to get one. And I'm not saying you necessarily have to get ours. Ours is geared to a specific type of investor. You know, our goal is consistency. We're not looking to make the biggest return. We're looking to make the most consistent return. And I think a lot of people appreciate that. But, you know, it's not for everybody. I understand there are people that want to make bigger gains. And we can construct portfolios that way, strategies that do, are more oriented towards high gains. But that's, as a firm, we're a pretty conservative firm. That's what we do. Anyway, strategy and tactics. You got to have both. You have to do both things. But if you're doing tactics and you don't have a strategy, I'm sorry, but you're setting yourself up for failure. Get yourself a strategy, whatever it is, and stick to it.